again, there's complicating factors in everything you do. You know, there's no real certainty totally of the law. There's a thing called a gift in contemplation of death. You ever hear that concept? You don't want to know about that yet. The gift in contemplation of death is exactly that. The laws in Ohio are such that if it appears that you did something strictly to avoid paying estate taxes, but remember they're going to go away here in another year and a half, and we're all going to live another year and a half. Right? So what happens is that asset gets pulled back in for estate tax purposes unless you can show that you didn't do it for purposes of avoiding estate taxes. Now, having said that, does anybody have any idea what the look-back period is for a gift in contemplation of death? Take a wild guess.
5 years.
15 years? Okay. 3 years?
5.
5. Whoever said 3 is right. It's 3 years. But as I said, that situation is a rebuttable presumption. And by rebuttable presumption, I mean they'll make, if it's within a 3-year period, they'll make the presumption it was a gift in contemplation of death, which you can always rebut it for other good reasons. You know, a lot of times you can convince them, especially if it's getting ready to go out of existence, the estate tax situation. So there's a lot of good reasons to consider the life estate situation. What about your bank accounts? Is there anything you can do with your bank accounts as you get older for estate planning
put them as a
purposes?
survivorship on it, can't you?
I heard POD, I heard survivorship. Anybody else want to throw in?
Can you put them in your children's name?
You can.
As alternate something or other?
What's
Put
that?
them on your thing.
Put them as alternates, inheritors, or?
Okay. You're on the right base. That one, I'll discuss that. One concept was survivorship, and that's been around for a long period of time. Do you understand what survivorship means on your bank accounts? I assume most of you, between husband and wives, have your bank accounts in survivorship. Do you know? Something to find out. You need to really find out and make sure that your bank, I believe, most financial institutions will probably lean you towards survivorship if they know that you're a husband and wife situation. They probably won't lean you towards survivorship if it's a children situation. You know how you easily can tell what's kind of the magic word? If it says joint, it's a joint bank account or it's a joint financial institution account, it's probably survivorship. Okay.
And does that mean if one passes away, it's not frozen? Or is it?
Yes and no. Yes and no. The good question over here was, does that mean if it's in survivorship and one person passes away, does it go without being frozen? How many of you say yes, it goes without being frozen? I got one over here. Is that it? How many of you say no? How many of you are two? I got two, one on the other way. Come on, you gotta make a decision one way or the other. Okay, how many of you say yes, it's not frozen? How many of you say no, it is frozen?
Well, doesn't it
How many of you are just
say
absolutely
and
refused to make a
or?
decision?
Depends on how the politicians word it.
That's how the politicians were, yeah. Okay. Well, the rule on that is that it's really not frozen anymore in the traditional sense. It used to be frozen even if it was survivorship until you did a tax release form with the county auditor's office telling them how much money was in there so that they could look and make sure you filed it on your tax return 9 months later. They've changed the law now in this area, and it really depends on how much money is in the account. But even if there's more than, if there's $25,000 or more in the account, technically you have to have a tax release form by the auditor's office first. Okay?
Even if it's joint?
Even if it's joint. Yes. That presupposes many things. Laura's not here. That presupposes they know the person's deceased. I'm not saying anymore. Presuppose that the other person is deceased, okay? It also, the process is really not as painful as it used to be. It's really a pretty quick deal to get the release form from the county auditor's office and freed up. And you want to do that pretty quickly because there's things you might want to pay out of the deceased's estate. So, yes.
So you're saying that if my husband and I have a joint account and he dies, I need to get a tax release form from the county auditor?
If you have more than $25,000
If you have more than
in a
25,000.
financial institution. So if you had $30,000 in the credit union and $15,000 in our junior partner in town, Hockey Valley Bank, you wouldn't need one for the Hockey Valley Bank, but you need one for the credit union. Okay.
So it has a...
And that's current, because I assume once they do away with the estate tax, this is going to go out the door. So it's not happening anymore at that point.
So that's a total at the institution, not necessarily per bank account.
It's
Within the
total,
bank
and yeah, it's total in your name. Yeah, you could have it, theoretically, you could have one $24,999 account with you and your husband, and you could have one $10.79 account with you and somebody else, and that would exceed the $25,000.
But if you split it up as like other banks, stay safe,
No, if you split up other banks,
that's a good thing.
that's a good thing, yeah. I don't know if the credit union wants me to tell you that, but yeah, that's a good thing. It's actually a good thing.
So if you have like a savings account that that isn't in your husband's name, so you could still put a survivorship on that account? Like,
Yes.
If you have your own private savings account also?
Well, they won't be your private account anymore if you put your husband's name on it.
But if I just want to put a survivorship on it though, like it's my savings account, but if I would die, I'd want him to have that money, that wouldn't give him access to my money right now, right?
Yes, it would.
Okay. I can't do that then.
I can tell you,
Payable on death.
yeah, payable on death is the other way around doing that.
Okay, I can do that, not this.
So if you do that, payable on death used to be very, very popular before I was born. And then it was not in vogue for a long time, and for about the last 5, 6, 7 years or so, payable on death has been a very useful estate planning kind of tool again right now. And does anybody have any idea what the difference between payable on death is versus a survivorship account?
Can't get through it access to it.
Yeah.
They don't sign a signature card, and we have to know.
Right. These are all the good reasons. They don't have any present interest in the account, whereas if you have a survivorship, they do have present interest. They can erase to the bank, the financial institution, and throw it all out. They don't have any present interest in the account. They don't have to sign anything. If they're on a survivorship, they're going to have to sign a signature card. And they don't even have to know that you've done it. You can put them on, you can take them off.
Is that something you do
That's
in
the other
a
one, yes,
will?
you can take them off.
Do you do that in a will, or do you do it at the bank?
You do that at the financial. That's part of your contractual relationship with the financial institution. So it really has nothing to do with your will. It's too late, basically, to time the will.
And you can't leave your bank account money in your will?
Yes, you can.
Okay, so
That's
you
the
could do
escape.
that.
That's the escape clause in your will, is to have in your will that all of the rest of your property is going to go someplace.
Okay.
You want to have that catch-all situation so that you haven't provided that. But the actual survivorship account with the bank is a contract with the bank. The payable on death is a contract with the bank.
So if you know who you want to have that, wouldn't that be the smartest thing to do so that you don't have to wait for your will to be probated to have to happen?
Yeah, the comment here is if you know what you want to do, isn't that the smart thing to do? Yes, it is. The problem is you get into is many, many times you have, let's say you have 3 children and you start off with and you have 3 $20,000 accounts. And so you give me as one of your children, one of the payable on death, one of them, Johnny another one, and Cindy, the other one. Then, and they're different financial institutions, okay, so we're cool. My financial institution I'm on pays 6% interest. Johnny's pays 3% interest. And Cindy's, pays 8 or whatever. They're not the same. So it doesn't take, see, it doesn't take very long before they get out of whack of being equal amounts of money. Then something comes along and you really need to buy something, you don't have any ready funds, so you use the money that's going to go to me. If you do that, it's almost a constant visual to make sure that they're equal. So there's pluses and cons to doing it. If you're not going to need it and you're just constantly rolling over CDs or something like that, you know, probably a good way to do it. But it is a good way to at least part of your estate to make it